The market gives and the market takes away. But what most traders never understand is this brutal truth. The market doesn't care about your entry price. It doesn't remember what you paid. It has no knowledge of your hopes, your dreams, or your financial obligations. The market is the ultimate truth machine, ruthlessly efficient at exposing the gap between your perception and reality. Most traders don't lose because they're wrong. They lose because they refuse to be wrong. This single psychological mistake, this stubborn resistance to accepting reality, is what transforms a small, manageable loss into financial devastation. You see it in every bear market: the initial denial, the desperate hope, the irrational commitment to positions that are clearly failing. It will come back, they whisper to themselves as the market continues its merciless descent. What separates the amateur from the professional isn't the ability to pick winners, it's the discipline to sell losers. Jesse Livermore, perhaps the greatest trader who ever lived, understood this fundamental truth better than anyone. He made and lost several fortunes throughout his career, but his most profound insight wasn't about how to make money, it was about how to not lose it all. And in a bear market, this distinction isn't just important, it's everything. The professional trader recognizes that market conditions have changed before others do. They act decisively while amateurs freeze in fear or denial. They understand that preservation of capital isn't just a defensive strategy, it's the foundation of aggressive opportunity when others have been wiped out. But this knowledge comes at a psychological price few are willing to pay. It requires you to confront your mistakes quickly, to override your natural instincts, to develop a system that protects you from yourself. Today I'm going to show you how Livermore mastered the art of selling in bear markets, not through mystical market intuition, but through psychological discipline and systematic risk management that you can apply to protect and grow your capital when markets turn hostile. In the autumn of 1929, while Wall Street burned and fortunes evaporated overnight, Jesse Livermore's account swelled with profits. He had not only anticipated the crash but positioned himself to profit enormously from it. His short positions yielded him over $100 million in today's currency, all while financial titans jumped from windows and ordinary investors watched their life savings disappear. This wasn't luck. It wasn't insider information. It was the culmination of decades spent developing a disciplined trading mindset that few have ever mastered. But Livermore's story isn't one of unbroken success. In fact, it's his failures that teach us the most valuable lessons about navigating bear markets. Before his legendary 1929 trades, he had experienced devastating losses, wiping out his entire fortune more than once. He'd felt the crushing weight of poor decisions, the paralysis of fear, and the seduction of hope when conditions demanded action. What made Livermore exceptional wasn't that he avoided mistakes, it was that he learned from them with ruthless self-examination. After each major loss, he would retreat, analyze his trading journal, and identify the precise moment when he had deviated from his rules. The pattern was almost always the same. He had seen the market reversal coming, felt it in his bones, but failed to act decisively enough. The market does not beat them, he wrote. They beat themselves, because though they have brains, they cannot sit tight. Consider the psychological journey of the average investor in a typical bear market. The initial decline is dismissed as a healthy correction. As prices fall further, they average down, convinced of the fundamental value of their holdings. The temporary relief of small rallies reinforces their false hope. By the time they finally capitulate, often near the bottom, their capital has been so severely impaired that recovery becomes a distant dream. Livermore observed this pattern repeatedly, noting that the inability to accept small losses inevitably led to catastrophic ones. He recognized that markets move in major trends, and fighting against these powerful currents was financial suicide. Instead, he developed a system of rules specifically designed to identify when a bull market was exhausted and a bear market was beginning, the precise moment when everything had to change. For Livermore, bear markets weren't something to fear but to respect and exploit. He understood that downtrends could be more profitable than uptrends for those with the right mindset and methodology. But this required an uncommon psychological transformation, the ability to completely reverse one's outlook and positioning at exactly the moment when most were still clinging to bullish narratives. The greatest challenge wasn't technical analysis or timing, it was overcoming the natural human resistance to accepting loss. As Livermore discovered through painful experience, This psychological barrier destroys more trading accounts than any market movement ever could. His solution wasn't merely a trading strategy, but a complete system for managing risk that began with a radical premise: the first loss is the best loss. Everything that followed from this principle would form the foundation of how he mastered selling in bear markets, and how you can too. The battle between bull and bear is not fought on the trading floor, it's fought in the mind of every trader, where emotion and logic wage a constant war for control, and it's a war that most of us are programmed to lose. Think about this. Why is it so psychologically difficult to sell in a declining market? Why do rational, intelligent people cling to losing positions as they watch their capital slowly bleed away? The answer lies in how our minds process loss. Behavioral economists call it loss aversion, the tendency to prefer avoiding losses over acquiring equivalent gains. Studies show that the pain of losing is psychologically about twice as powerful as the pleasure of gaining. This fundamental asymmetry in how we experience profit and loss creates a dangerous trap for traders. When a position moves against you, your brain's first response isn't rational analysis, it's emotional self-protection. You don't want to admit you were wrong. You don't want to feel the sting of regret. So your mind creates elaborate narratives to justify inaction. It's just a temporary pullback. The fundamentals haven't changed. I'm a long-term investor. These mental justifications feel like wisdom, but they're actually a form of denial, a psychological defense mechanism designed to protect your ego, not your capital. Jesse Livermore recognized this conflict decades before modern psychology gave it a name. He understood that the greatest enemy wasn't the market, it was the undisciplined mind reacting to the market. The human side of every person is the greatest enemy of the average investor or speculator, he wrote. The weaknesses that all people have, fear, greed, and hope, always overtake them and are the reasons why they lose money when trading or investing. But how do you overcome something so deeply ingrained in human psychology? How do you train yourself to act decisively when every instinct is screaming at you to wait, to hope, to average down? Livermore's answer was system over emotion, rules over impulse, discipline over hope. Consider what happens in the early stages of a market reversal. The first significant decline usually comes after an extended period of investor confidence, sometimes even euphoria. Valuations are stretched. Everyone has a story about their investment genius. Warning signs are dismissed or rationalized away. When the market begins to falter, the initial response from most investors is to see it as an opportunity, a chance to buy at slightly lower prices what had recently been selling for more. This is precisely when Livermore would become most alert to danger. He developed specific signals that would warn him that the market character had changed: a failure of strong stocks to make new highs, deteriorating market breadth, leading sectors starting to lag. These technical signals weren't merely abstract indicators, they were alarm bells triggering a predetermined response. For Livermore, these signals demanded a complete reversal in thinking. While others were looking for buying opportunities, he was systematically reducing exposure or positioning for decline. This mental flexibility, the ability to completely reverse one's market outlook when the evidence demanded it, separated him from traders who remained committed to a single directional bias. But here's where most traders fail. They see the same signals, they feel the same concern. They may even intellectually acknowledge that the trend has changed, yet they don't act decisively enough. Why? Because selling crystallizes loss. It forces you to confront the gap between your expectations and reality. It requires you to admit a mistake, and the ego hates nothing more than admitting error. So instead of decisive action, there's hesitation, partial measures, half-hearted risk reduction that ultimately proves insufficient as markets accelerate downward. What psychological mechanisms did Livermore use to overcome these barriers? First, he completely separated his identity from his trades. Being wrong about a market position didn't make him a failure, it made him a trader who had taken a loss, nothing more. This emotional detachment allowed him to view market positions objectively as problems to be solved rather than extensions of his self-worth. Second, he developed a profound respect for risk that bordered on paranoia. Livermore understood that preservation of capital wasn't just about avoiding bankruptcy, it was about maintaining the psychological stability necessary to recognize and exploit future opportunities. There is a time for all things, but I didn't know it, he once said about his early career mistakes. And that is precisely what beats so many men in Wall Street who are very far from being in the main sucker class. There is the plain fool who does the wrong thing at all times, but there is also the Wall Street fool who thinks he must trade all the time. This brings us to perhaps his most counterintuitive insight. Sometimes the most powerful action is inaction, the discipline to stand aside when conditions are unclear. In the transition from bull to bear market, there is often a period of heightened volatility and false signals. During these phases, Livermore would often reduce his exposure and observe, waiting for the market to reveal its true direction before committing significant capital. Ask yourself, do you have the discipline to do nothing when nothing is the smart thing to do? Livermore's system for navigating bear markets involved three core principles that directly confronted common psychological weaknesses. First, the discipline to take small losses quickly before they become large losses. This requires overcoming loss aversion and pride, accepting that being wrong is part of trading. Second, the patience to wait for clear signals of a trend reversal before taking major positions. This counters the fear of missing out and the need for constant action. Third, the courage to act aggressively once a new trend is confirmed, even when it contradicts popular sentiment. This means overcoming the social instinct to run with the herd. These principles sound simple, yet they run counter to our most basic instincts. When a position moves against us, we want to hold on, hoping for recovery. When the market is in flux, we feel compelled to act rather than wait. And when everyone around us believes one thing, it takes tremendous conviction to believe and act on the opposite. For Livermore, the solution was turning these principles into rules, specific actionable guidelines that removed emotion from the decision-making process. He didn't trust his future self to make rational decisions under pressure, so he created a framework that forced discipline when he knew emotional biases would be strongest. A loss never troubles me after I take it, he noted. I forget it overnight, but being wrong, not taking the loss, that does disturb me. In bear markets, this discipline becomes not just important but essential. The very nature of downtrends, their velocity, their ability to destroy capital quickly, their psychological impact, makes them fundamentally different from bull markets. They require a different mindset, different strategies, and often a complete reversal of the habits that seemed to work during the preceding bull run. The question isn't whether you'll face these challenges, it's whether you've built a system to overcome them before they arrive. So how do we transform these psychological insights into a practical system for selling in bear markets? How did Livermore convert philosophy into methodology? Let me show you the exact framework he developed, a system of rules that doesn't just tell you when to sell, but forces you to sell when your emotions are screaming to hold on. The foundation begins with Livermore's pivotal insight, the initial reversal signal. For him, this wasn't about complex indicators or esoteric chart patterns. It was about the market's failure to behave as expected. When strong stocks couldn't make new highs in a supposedly bullish environment, when market leaders began to falter, when rallies became weaker and shorter in duration, these were the warning signs that demanded immediate attention. But recognition wasn't enough. What separated Livermore from his contemporaries was his response to these signals, a systematic, almost mathematical approach to risk reduction that left nothing to chance or emotion. First came the probe test, a deliberate reduction of 10–20% of his total position after the initial warning signs appeared. This wasn't a panicked reaction, but a calculated test of market conditions. If the position continued to deteriorate, it validated his concern, triggering further reduction. If it stabilized or improved, he could always re-establish the position with minimal cost. This strategic retreat allowed him to reduce risk while gathering vital market information, a low-cost way to test his thesis about changing market direction. My sitting tight is based on my observation that people don't take profits because they don't know when to, Livermore explained. They have merely a vague idea that they will sell when they have a big profit. But that's an impossible thing to determine in advance, so I make it a rule to start taking profits after I've been right for a while. When the evidence confirmed a genuine trend change, Livermore implemented what he called his reversal rule, a complete liquidation of long positions and, if conditions warranted, establishing short positions in the weakest sectors. This wasn't done all at once, but in a deliberate sequence that maintained discipline while minimizing emotional strain. Crucially, these actions weren't based on price levels alone, but on a combination of price behavior, time, and market breadth. Livermore understood that bear markets don't just go down, they go down in a specific way with identifiable patterns of distribution, failed rallies, and accelerating downside momentum. His most powerful tool was perhaps his simplest, the predetermined stop loss. But Livermore's approach to stops was more sophisticated than the basic price triggers most traders use today. He developed a three-tier system. The first tier, the initial risk stop, was set at the point where his original thesis was clearly wrong. This might be 7–10% below his entry in a normal market, but he adjusted this based on market volatility. This stop was non-negotiable, removing the psychological burden of decision-making when under pressure. The second tier, the profit protection stop, would be implemented once a position moved in his favor. He would move his stop to break even after a position showed a predetermined profit, ensuring that winning trades couldn't turn into losers. The third tier, the trailing stop, would ratchet higher as profits increased, locking in gains while allowing the position to develop. This systematic approach to profit protection prevented the common trap of watching large paper profits evaporate during market reversals. But Livermore's true genius came in how he applied these rules asymmetrically between bull and bear markets. He recognized that downtrends move faster and with greater volatility than uptrends, requiring adjustments to both position sizing and stop parameters. In bear markets, he reduced his standard position size by 30–50%, acknowledging the increased volatility and risk. Stops were placed wider to accommodate volatility, but overall exposure was lower. This mathematical approach to risk allowed him to participate in downtrends without being shaken out by the violent counter-trend rallies that characterize bear markets. For those positions he maintained on the short side, Livermore employed a pyramiding strategy, but with a crucial difference from how most traders approach it. Rather than averaging down, a common and destructive practice in declining markets, he would add to positions only after they had moved in his favor and only at sequentially better prices. This meant his largest position would always be his most profitable one, creating a positive feedback loop between psychology and mathematics. As his confidence in the trade increased, backed by evidence of profitability, so did his position size. But this additional exposure came with built-in profit buffer, dramatically reducing overall risk. The successful trader has to fight these two deep-seated instincts, Livermore observed. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear that his loss will develop into a much bigger loss, and hope that his profit will become a big profit. Perhaps most valuable for today's traders is Livermore's sector rotation framework for identifying selling opportunities. He meticulously tracked leadership groups, recognizing that market tops form in a sequence, not simultaneously across all sectors. The first warning comes when the most speculative high-beta stocks begin to falter while blue chips continue higher. This divergence, which might appear temporary to most observers, was for Livermore a critical signal that smart money was quietly redistributing risk. By the time the trend became obvious to the average investor, Livermore had already significantly reduced exposure. This sectoral approach extended to his method for initiating short positions as well. Rather than shorting the strongest companies, a common mistake, he focused on identifying the weakest companies in weakening sectors, those with poor fundamentals that had been temporarily lifted by the rising tide of the bull market. These would be the first to collapse when market conditions deteriorated. What makes Livermore's system so powerful is that it directly confronts our psychological biases. The predetermined stops remove the burden of decision-making during periods of maximum stress. The pyramiding approach aligns position sizing with demonstrated success rather than hope or conviction. The probe method allows for low-risk testing of market conditions rather than all-or-nothing commitments. Most importantly, his entire framework acknowledges a truth that most traders never accept, that markets change, trends reverse, and what worked yesterday may not work tomorrow. This mental flexibility, codified into rules and procedures, is what allowed him to navigate the transition from bull to bear markets when others remained frozen in denial or hope. The game of speculation is the most uniformly fascinating game in the world, Livermore wrote. But it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. The system I've outlined isn't just historical curiosity, It's a practical framework for navigating today's bear markets, built on timeless principles of risk management and psychological discipline that remain as relevant now as they were a century ago. What separates those who survive bear markets from those who don't isn't intelligence or information, it's psychological discipline. We've explored Livermore's system for mastering the sell decision, his probing technique, his three-tiered stop-loss methodology, his sector rotation analysis, and his mathematical approach to position sizing. But underlying all these tactical elements is a profound truth. The greatest risk you face isn't in the market, it's in the mind behind every trade. Every bear market in history has followed the same emotional arc. First denial, then concern, then fear, then capitulation, and finally despair. The financial damage inflicted during this progression isn't distributed equally. It concentrates most heavily on those who refuse to acknowledge changing conditions until it's too late. This is why Livermore insisted that successful trading is only 10% about market knowledge and 90% about self-control. The rules and systems we've discussed aren't merely techniques for protecting capital. They're psychological guardrails that prevent your natural human instincts from destroying your financial future. Consider this uncomfortable question. What beliefs are you currently holding that you might be unwilling to abandon even in the face of contradictory evidence? What positions, both financial and psychological, have become so integrated with your identity that letting them go feels like losing a part of yourself? This is where the real work begins. Because mastering the sell decision isn't just about implementing Livermore's rules, it's about developing the self-awareness to recognize when your own psychology is creating risk that no stop-loss can protect against. There is only one side to the stock market, Livermore reminded us, and it is not the bull side or the bear side, but the right side. The right side requires the courage to act when others freeze, the patience to wait when others rush, and the discipline to follow your rules when emotions demand exceptions. It requires you to embrace the most difficult truth in trading, that being wrong isn't just acceptable, it's inevitable. The only question is how quickly you recognize and respond to it. Bear markets don't just reveal financial truths, they reveal character. They show us who has built their strategy on hope and who has built it on discipline. They separate those who understand risk from those who only understand reward. The market will test your rules, it will test your resolve, but most of all, it will test your relationship with being wrong. And in that test lies the ultimate lesson. Your greatest edge isn't in what you know, it's in how you respond when what you thought you knew turns out to be wrong. What psychological habit is currently putting your capital at risk, and what rule could you implement today to protect yourself from it?